From America, David Jones, and from BlackRock, Michael Fredericks joining us now. David, I want to start with you and get straight to the headline from you, sir, because this headline is unbelievable. I had to read it about 10 times. Equity inflows over the last 5 months versus the last 12 years. Are you telling me we've had more inflows into stocks over the last 5 months versus the last 12 years?
Yeah, that's absolutely right. The flows into funds and ETFs has been larger over the last 5 months. It just points to what we've been talking about in our recent reports, which is that we are hitting a period of peak positioning, as well as peak profits in companies, as well as peak policy from the authorities.
David, you and I are going to talk about peak positioning in the fund manager survey you put out this morning over at Bank of America in just a moment. Bond markets, Bank of America unveiling its April fund manager survey with a taper tantrum very much top of mind. For more, let's bring in Bloomberg's Kelly Lyons. Hey, Kelly.
Hey, John. A taper tantrum top of mind, but the subject line for this fund manager survey was as boom as it gets. Bank of America calling it uber bullish, saying positioning is peaking and therefore it's time to get cautious on risks. To run through some of the results, 50% of respondents said that the world economy is on a V-shaped recovery path, and a record 93% expect inflation to be higher over the next 12 months. As far as the equity market goes, banks were the biggest sector overweight for the first time since May of 2018. And as for where we are in the equity cycle, 7% of people say we're in a bubble. 25% say that we are in an early stage bull market, and 2/3 say actually no, it is late stage. Then on to the most crowded trades. It's a lot of things that are long tech, long Bitcoin, long ESG, all at the top of the list. And on that long Bitcoin point, I would note 74% of investors actually said that Bitcoin is in a bubble, which was an interesting little tidbit there. And then when looking at tail risks, Bank of America saying they're now associated with a boom, not a recession. In that 32% said a bond market tantrum was the biggest risk, with 2.1% seen as the quote unquote level of reckoning for a potential stock market correction. Then that risk was followed up by inflation at 27%, though both of those were actually cited by fewer respondents than the March survey. And at the same time, higher taxes rapidly creeping up on the list of concerns. 15% of respondents said that was the biggest tail risk. Less than 5% said that last month, John.
Kelly, thank you. Let's get some final thoughts with Bank of America's David Jones. David, lucky to have you with us this morning to pour through this survey. The headlines: peak policy, peak profits, and peak positioning. What's your takeaway, David?
Yeah, it's very much as you said. We entitled this as boom as it gets, and it really is reflecting what we see as sort of the peak in certain macro and market expectations, whether it's the V-shaped recovery expectations, which is now at 50% of the respondents compared to 10% a year ago, whether that's in terms of EPS expectations, GDP expectations, CPI expectations, whether that's in terms of what CIOs want companies to do with excess cash. They now want them to 57% of our respondents said that they want companies to invest that cash in CapEx rather than returning it to shareholders or paying down debt. So this is just a very bullish survey like we've seen for most of 2021.
Record expectation that value beats growth. No surprise, banks now the big overweight the sector by the most since May 2018. David, what I've always enjoyed about the survey is just the bottom paragraph when you recommend some contrarian trades. So what are they now?
Yeah, I mean, so if you, our contrarian trades, if you believe that rates are going to continue to rise, then perhaps you want to start looking at tech or energy and some of those. But what we've really been seeing is that what our clients have been doing over the course of this month has been a rotation to technology and healthcare and REITs, and they've been rotating out of emerging markets and out of staples.
Can you walk me through the EM trade, David? It was so big coming into 21. Have you seen a tempering of that appetite?
Yeah, it's really been somewhat remarkable. At the beginning of 2021, it was the #1 trade among our survey respondents, and that has since ebbed. And a lot of that has to do with the rise in U.S. interest rates, which has made emerging markets less attractive. Many of these emerging markets are sort of trapped between a slow vaccine rollout of their own and slow domestic growth and rising international rates. And so that also affects their currencies. And now what we've seen our survey respondents saying is that they are still overweight on emerging markets and they still like emerging markets. But the #1 trade for 2021 is now, if you can believe it, the S&P 500.
David, it's good to catch up off the back of this report. Please come next month as well. I enjoyed that. David Jones there of Bank of America.